One of the biggest financial goals you're ever going to tackle is saving for a house deposit. And whilst you're grafting away to earn and save more money, it can be unbelievably frustrating to see the money that you have saved just sitting there, not really working for you, earning practically zero in interest. But on the other side, you may have recently discovered the world of investing and how with relatively little knowledge or effort, you can go out and invest in thousands of companies from all across the world and benefit from their growth. So why not get that cash off the sidelines and start investing? Well, today we're going to be digging into the data and I'm going to help you decide whether you should be investing for your short-term goals. Hello and welcome back to the channel. If you're new here, hi, my name is James, and this is the place where you can learn everything that you need to know to make better financial decisions. So the question of the day is, I have a goal to buy a house in 4 years' time. Is it safe to be investing in the stock market? Now, this video is not just going to be about saving for a house deposit. We are going to be looking at any goal, any financial goal that you want to achieve in the next 5 years and whether you should be investing in the stock market to help you achieve that goal. Now, whilst you've been learning about investing, you've probably come across multiple people that have said that you should not be investing in the stock market if you cannot afford to keep that money invested for 5 years or longer. But why do they say this, and is it really true? Well, as you may have already realized, there are very few hard and fast rules when it comes to financial planning. And the answer is going to depend very much on your own personal situation. So in this video, I'm going to lay out all the facts and factors that you need to consider when making this decision so that ultimately you can decide whether investing for your short-term goal is right for you. So this is the thing. The stock market has always gone up. And all evidence is suggesting that it will continue to do so. And I have very little doubt that in 10 years' time, the stock market will be significantly higher than where it is today. But as you'll know from the crash that happened last year, that journey is likely to be pretty turbulent. And last year's crash was not a typical market crash because the markets recovered their value within a few months. Whereas typically after big crashes, this can take 3 to 5 years, or in some cases much, much longer. After the dot-com crash in the early 2000s, it took the S&P 500 6 years to work its way back to its previous peak, only to then immediately experience another crash in 2008 that took another 4 years to recover from. But it's very easy to forget that, especially if you weren't there to witness it. I mean, in 2008, I just started university, and to be honest, I had much bigger problems to worry about, like who I was going to live with in second year in my Modern Warfare 2 prestige rank. And when I eventually did leave university in 2012 and I started working in investment management, the markets had already begun the longest bull run in its history. So I have personally never experienced a prolonged market crash or a bear market. And that's actually quite a funny thing to think about, that most of the financial analysts that are working around the world today, most of the younger guys that are doing all the heavy lifting, haven't actually experienced what it's like to be investing through a market crash. Now, these analysts, just like me, have spent a lot of time researching what happened in the past and what happened in those crashes. And we understand that this will happen again and it will be bad. But from the perspective of literally anyone who started investing in the last 10 years, the stock market has only ever gone up, and it's gone up a lot. And it's in this environment when it becomes very easy to get overconfident and to assume that it's going to continue on its trajectory. But the question is, what should we normally expect from the stock market? And what are the chances of getting a positive return if you do choose to invest over the short term? Well, to give us an idea, it makes sense to look back at what's happened in the past. Now, there is no guarantee that history will repeat itself, but looking back at long-term data can certainly help us to guide our decisions. So here we're looking at the past performance of the S&P 500 over different rolling periods between 1926 and 2017. So this probably looks a little bit confusing at first, but let me just talk you through it. So we look at the first line. This one's a little bit easier to understand. So you've got daily returns, and in this period there were 23,259 days, of which 53% were positive and 46% were negative. And then you can see how many months, how many quarters, how many years there were in this period. And the chances of over a year receiving a positive return or a negative return. But the bit that we're really interested in is this bottom part here, which shows us the rolling returns. So what this first line is showing us is that if you had chosen to invest your money at any single month in this entire period, so there was 1,093 possible times in which you could have invested, and you'd held your money for 1 year, what were your chances of getting either a positive or negative return? It's got 74% a positive and 25% negative. Now, 5 years, again, this is looking at every single possible month that you could have chosen to invest and imagining if you had held your money for 5 years, what would be your return? So 87% positive, 12.5% negative. Over 10 years, it goes up even more, 94% positive, and then 20 years, 100%, 25 years, 100%. Or we could look at this another way. Here we've got the same data, but displayed as a graph, which shows that ultimately, as you invest for longer, your chances of getting a positive return increase over time. So what are you thinking now that you've actually seen this data? Do you think that the prospects of investing over 2 to 5 years look good? Because I know there's some of you that are probably thinking, that doesn't look too bad. I'd take a punt on that. But then there's also some of you thinking, hell no, I would definitely not go anywhere near that. I personally think that these numbers actually look pretty good. I mean, an 87.5 chance of being up over 5 years, I'd take that. But the problem with this data is it's not giving us a full picture. We're missing a whole dimension from this. Yes, we may be up over 5 years, but how much are we likely to be up? And if we're going to be down, how much are we going to be down? Well, let's take a look. So here we're looking at the annualized return of the S&P 500 dating back to 1872. So that's a long time. And each bar represents the return that was achieved in that year. But we're also going to be looking at the annualized returns achieved if you'd stayed invested for different periods of time. The 1 year time frame shows us the return we would have got if we'd started investing at the beginning of each year and sold out at the end of the year. Now, as you can see, it's pretty volatile, it's pretty variable. There's lots of years that are up, there's also lots of years that are down. Now, the 5 year time frame is showing us the annualized return that we would have achieved if we had started investing at the beginning of each year and then held on for another 5 years. Hence why the first bar starts at year 5. And this bar represents the return that was achieved over the previous 5 years. Now, these returns do look smaller than the 1 year returns, but that's because they're annualized. So each bar represents the average return that you would have got over each of those 5 years. As you can see, these returns are a lot less variable. They're a lot less extreme than the 1 year period. And here, the biggest loss was minus 11% a year. But remember, that's minus 11% every year for 5 years. So in total, that's around about minus 86%. But again, there are very few of these negative periods and there's a hell of a lot more positives. And then over the 10 and 20 year timeframes, we can see that this trend continues and the dispersion of returns becomes a lot more concentrated. It becomes a lot more predictable. There's also a lot less negative returns until you get to year 20, the 20 year timeframe, where there's no negative returns at all. Now you need to remember that this is past performance. And although it may give us an indication of what may happen in the future, it is by no means guaranteed. But clearly, if you're investing over a 10 or 20 year time frame, which all of you will be doing at some point in your lives, then you can be very confident that you're going to see a positive return no matter when you choose to invest. But if you're investing for less than 5 years, then although the probability of getting a positive return may look good to you, there is still a significant chance that you can end up with a negative return and you can end up down a lot. Again, the purpose of this video is not for me to be telling you what you should or should not be doing. All I want to do is give you all the facts, all the things that you need to consider so that you can make this decision on your own. Now, I appreciate looking at this data on this small screen probably isn't the best way to analyze it. So I've included links down in the description to all of the data that I've used in this video. But beyond this raw data, there's still another couple of things that you need to consider when making this decision. The first is stress. Now, when you're investing for the long term, it's quite easy to shrug off the ups and downs and even crashes in the market because you know that you've got time on your side to wait for those markets to come back. But if you're investing for a short period of time, you're going to be hanging on to every single movement in the markets. You're going to be checking your portfolio all the time, always on your phone, and this is going to cause a lot of stress. And stress results in bad decision making. And you need to remember that all those figures that I've just showed you were where somebody was systematically investing and holding that investment for a certain period of time. But in reality, short-term investors find it very difficult to stay the course, even for short periods of time, because they become ruled by their emotions. They become ruled by their inner chimp that ultimately wants to react in the worst possible way. When the markets go up, you feel like you want to buy. When the markets fall, you feel like you want to sell. And that's just because there's so much stress that is bringing out the inner chimp in you that's going to make you make exactly the wrong decisions. So number 2, being flexible with your goals. Now, if you absolutely have to buy a house in 3 years' time because you've got a young family and you're growing out of your home, then obviously you don't have much wiggle room. But if you can be flexible and you're willing to push your goal out if the markets fall, then that's going to give you a much higher chance of getting an overall positive return. And it's also going to alleviate some of the stress that's going to come with investing. It's also really important to be realistic with your goals. We here in the UK put so much pressure on ourselves to get on the property ladder because we think that if we're renting, then we are ultimately just throwing away money. But the reality is that the pros and cons of home ownership versus actually renting and investing that money that you would have spent on buying a home is not actually as different as you might think. Well, at least from a financial perspective. Now, I will certainly do a whole video on that in the future, but it's really important that you think about your goal and make sure you're not just trying to buy a house in 4 years' time because everybody else is. Having a house and a mortgage does tie you down, but if you're in your early 20s, do you really know what you're going to be wanting to do in 5 years' time? So maybe it's good to just keep things flexible. Number 3, only invest a small amount of your cash. You need to remember that this is not an all or nothing decision. You may feel like you're willing to take the risk, but only with a small amount of your savings. And with this, it might be helpful to plot out a number of different scenarios. So looking at some of the data that I've showed you today, work out a worst case or best case scenario for your investments over the next couple of years before you hit your goal. And if you look at that and play around with different levels of investment, you can work out how much risk you're ultimately comfortable with taking. Or another way to look at this is like you're investing, but you're taking a lot less risk than you normally would. So if you choose to invest 20% of your savings, that's kind of like investing in a 20% equity, 80% bond portfolio, but obviously now you've just got the money in cash. Number 4, investing to learn. Now, this is my own personal opinion, and there will probably be some people that disagree with me on this, but I think that everybody should be investing no matter what their situation is. Whether you are at university or maybe you're aggressively saving for a house deposit, I think that there is so much that can be learned from having even a small amount of money invested in the stock market. Even if it's £100, £1,000, it doesn't matter. You're still going to learn a huge amount. I've said this before and I'll say it again. The biggest challenge that you're going to face as an investor is not choosing where to invest or what account to open, because you can learn all of that from YouTube or from the internet. The biggest challenge you're going to face is actually you and managing your own emotions when it comes to investing and having the confidence to stick by the decisions that you make. Now, that stuff cannot be taught. It can only be learned through experience. So the sooner that you can get out and start investing and start learning, the better. You will make some mistakes, but it's much better to be making these mistakes early on in life where you're dealing with smaller amounts of money than later on in life where the stakes are much, much higher. But if you choose to do this, you need to make sure that you are engaging with it properly, and you need to make sure that you do actually learn from your mistakes. So that's it for the video today, guys. I hope this has given you some insight into the things that you need to be thinking about when you're going to be making this decision. If you found this video useful, please do share it with somebody else, because I know there's going to be a lot of people that are looking for answers about this question. Thanks for watching, and I hope you have a good day.